Hi there, it's Bill with Smart Trades. It's Monday, May 10th, and just wanted to review and also look at the current market action. Um, since we have hit the targets I mentioned on April 25th, on that date, I said that my targets were 1222 and 1223 basis the S&P cash. The next day on the 26th, the S&P peaked at 1219.80. That's less than 0.2% from our target. And the implications of our count was that we were expecting a decline of several hundred S&P points, and obviously that has already occurred. But I don't think it's done. More than likely, we've got lower to go. But let's back up and review just a bit of the short-term price action. Off of that high on the 26th, we have what I have labeled either 1 or a rally back to a lower high at 2, or B, and then a rather crazy looking 5-wave structure down, which I prefer to count as 1, 2, 3, 4, occurring with a high around the 1175 area, and then an extended fifth with the panic that we had last week. Now, the exact context of and how to label that big decline remains to be seen. We need to get more data to be sure of how to label it, but I think it does best count as an extended fifth wave. It's obviously not a third wave because we've retraced too far already for that to be the case. So let's see. At any rate, the target, the top of the previous fourth wave of one lesser degree, is again about 1175 basis the S&P cash. We're already into that previous fourth wave zone, so we don't necessarily have to get there. However, breadth is so strong right here that it does favor at least some higher price action. And again, the ideal target is 1175 on the S&P cash on the short term. If it goes through there, and particularly if it goes through 1192, it's likely that this decline to the lows last week is just A, and that we're in a B wave rally that could take us all the way back to the 1220s. But I don't favor that at this point. We'll take it one step at a time. Here again is that weekly chart, and again, the 1222, 1223 target, not quite hit, 1219.80, but that's less than 0.2% margin of error. From there, we've dropped into the previous fourth wave range, which is a pretty wide range. I'd prefer to see it down the bottom of that range. Moreover, this is just too quick and too short in terms of time a correction to have corrected that entire rally that has lasted about 13 months. You'd want to see 3, 4, 5 month correction at least. And the possibility exists that this is not an impulse wave up, that it is a triple zigzag, as others have mentioned. And if that's the case, we're actually going to see new lows. But let's take it, again, one step at a time. To this point, we've got a decline that can even be counted as an ABC. And we are expecting lower prices, so it really doesn't matter what the long-term count is here in terms of a trading philosophy at this point. What we're looking for is a corrective rally to sell into, and a low-risk place to try to enter the market, rather than trying to predict what's going to happen for the next 100 years or whatever. Okay, here is the NASDAQ 100. Same basic pattern there. Again, a possible 1, 2, or A, B decline off of the highs, as seen over here. And then rather a better pattern to indicate the possible extended fifth here, where you have a clear fourth wave type of pattern. And for the NASDAQ, that high of the previous fourth wave is around 1971. So that's a tentative target. Again, not only is that the top of the previous fourth wave, which is a natural target, but we also have an A equals C at just below that area, perhaps around in the 1960s. So let's watch that area carefully. Again, if it rallies back through the bottom of wave 1, that breaks the impulse scenario completely, and we're possibly in a B wave rally. Now, changing pace just a bit, here's a weekly chart of Google. I talked about Google some time ago, and I looked at the possibility that the decline, that it had peaked first, and that the decline off of that high was a developing ABC decline. With the decline last week, we now have the market holding on a closing basis at A equals C, which is typical Elliott wave, and a 38% retracement of the entire rally. So it's possible, at least in my mind, that Google has already completed or is nearing completion of a correction of the entire rally of 2009. This is interesting for a variety of reasons, but probably foremost, Google has tended to foreshadow what happens in the market at large. Back in March of 2009, Google made a higher low, and I think that was important at the time, but more importantly, it's peaked ahead of the market, peaking right at the around the new year, and declining from there. And so, if this low does hold, it kind of gives us a roadmap of what the correction in the NASDAQ and the S&P might look like in terms of time and perhaps price as well. At any rate, that decline is about 4 months, from New Year's till just last week. And so possibly a completed correction and a bit of a foreshadowing of things to come. Finally, here's TLT. It's a surrogate for the bonds. Nice gap to fill here, possibly around the 9170 area. If we were to come down to there coinciding with the market peaking, that'd be an interesting place to take a look at the possibility of going long. And looking for a reversal to the upside in TLT and the bonds in general. Just another quick note, I'm going to back up just a bit here. The count that I've got on the weekly chart, I found it actually somebody who had criticized the count on my site wound up posting this a variation of this count on their own YouTube site. Now, just a reminder, everything on this site is copywritten by Smart Trades Inc. So if you're going to post it elsewhere, at least give credit for it. If not, it is an infringement on copyright law, which YouTube enforces pretty stringently. And make no mistake, I will go after anyone who is basically stealing my work and posting it as their own elsewhere, be it on YouTube or anywhere else that I find it. So. Not to end on a negative note, but the person that actually is taking this, borrowing, shall we say, the count, or at least this portion of the count, which as far as I know is completely unique, and that being this irregular correction here that I noted again in the April 25th report. I actually have it privately documented back in early April as well. But anybody who decides to use that as their own, if you don't give credit for it, that is a copyright infringement. And since you're actually criticizing the counts and then stealing them, I find it, I do find that offensive, and I'll go after you. Anyway, thanks for listening. Sorry to bring up the business end of it, but if somebody's going to criticize me and then steal my work, I just find that not right. Thanks for watching. Have a great day, and good luck.